Two best stocks to buy in the stock market right now. This is what this video is about. I'm going to explain two stocks that I believe are good buying opportunities. The first one, I've never talked about it before, is going to be a little bit controversial. I never discussed it before. The second one is a stock I've discussed before. Both of them are large caps, quality stocks, or whatever you want to call them, growing companies. And I think you're really going to enjoy this video. I don't do it very often. If you do enjoy it, please press the like button and let me know what you think in the comments. If you agree with me, or maybe you disagree with me, let me know what you think in the comments. Now, the first one, which as I said is going to surprise a lot of you, and this is Amazon. Yes, I am mostly bearish on Magnificent Seven stocks. I told you that there's a rotation happening, and I think a lot of them have much lower to go. But it doesn't mean you should go and try to time the market if you're really trying to buy any of that stuff. I mean, if something is fairly valued, even if you believe it's going to go down, I think it's a big mistake to wait for a correction on a stock that you believe is fairly valued. And that's what I see with Amazon. I think Amazon is fairly valued to an undervalued stock. And I did make this post on Twitter. I tend to post stuff on Twitter, or X if you want to call it, to try to understand what is the general opinion or the general sentiment around a specific stock. And that stuff is very important to me. And most of the counter arguments that I saw, you could go and read the comments, but the main reason for the hate on Amazon, or the counter argument, is that Amazon is up so much. So if you look at the chart, Amazon last year was trading around $94, $95. It's up 100%. Now it's sitting at $183. So we missed the boat. So now Amazon is overvalued, and it's just not a buying opportunity. And all the comments were made based off how much Amazon is up. And this is one of the biggest mistakes that people make, especially I notice on YouTube. Under my videos, I talk about so many amazing companies, and just because the stock is up, this is all I get. I mean, I make amazing videos on fundamentals, how amazing the company is, how undervalued the stock is, how everything is. And the main comment I get is, yes, but the stock is up 5% from 52-week close. I mean, it's absolutely insane. Like, I discussed this stock before called Cheniere Energy, and it was up, I think, it was like 6% from 52-week low. And I made, which I believe was an amazing video on the stock. You could check it out. I went into the details. I showed you my emails with the investor relation page. I did an amazing video on fundamentals. But all the comments were on how much the stock was up from 52-week low, and it means the stock could pull back. I mean, even though I told you the stock could double in 3 years, the main argument I got was that the stock could have a pullback because it's up so much, which wasn't even up so much. And to me, it's absolutely insane. And you have to focus on the value, not the price. So yes, Amazon stock is up 35% over the last year, but free cash flow is up 45%. So is Amazon is really this overvalued? I mean, we're going to find out. But you cannot let the price influence your decisions. You have to close your eyes, ignore the chart, and focus on the fundamentals. And it's very hard to do. But for the last quarter, Amazon did absolutely amazing in my opinion. They blew out a lot of the estimates. 13% up in FX adjusted, if you want to say, 30% in net sales. Amazing stuff. Free cash flow has been beast. It's finally showing up. After years and years of disappointment, free cash flow is showing up as the CapEx cycle, in my opinion, has likely peaked or is going to slow down from here in terms of growth, and it's going to mostly be showing up in cash from operations, massive expansion. Free cash flow is likely going to continue. And I should say cash from operation was up 45%, not free cash flow. Free cash flow, I believe, was up much more than 45% over the last year. They had Prime Day recently. Prime Day was an absolute success. It was a record in terms of Amazon. They shopped $14.2 billion, an 11% jump from last year. And yet, we know that the consumer is weak, but as Buffett said, never bet against the American consumer in terms of spending. I mean, they do buy now, pay later, credit card, whatever it is, they're gonna spend money, and that's how it's always been. It's been a bad idea to bet against the consumer in the United States. Even though we have student loans, we have many different things, they're always going to find some kind of way to spend even more money, especially if we have lower interest rate in the future. Is even going to amplify the spending, in my opinion. You look at Amazon Prime users. I'm not sure if this is 100% accurate, but that's what I got from Statista. It's 180 million members. I mean, this is absolutely insane for Amazon Prime. The monetization is insane. You still have Amazon Web Services, which a lot of people hate on it because I think it's not growing as fast as, Microsoft Azure has been taking market share. But these are the top three: Microsoft Azure, AWS, Amazon Web Services, and Google Cloud. Alibaba Cloud has been, fairly stagnant on a relative basis to the other ones. And Amazon Web Services is still king in terms of market share. It maintains 31% as of Q1, as of Statista's data, 31% versus 25% for Azure. And yes, it makes a large percentage of operating income. But again, in my opinion, maybe it's not growing the best, but it's still maintaining good market share. And Amazon is much more than just Amazon Web Services. A lot of people talk about Temu, how Temu is taking over Amazon. I personally don't think so. I think Temu is hurting, $5 or $5 below. I think the store is. A lot of you asked me about the stock, five below or something, and I looked at it, and I mean Temu is killing them. That's just the way it is, and it's really hurting these models of selling gadgets below $5 and phone chargers and all kind of toys under $5 or $10. I mean, people are just going on Temu. They're getting amazing deals. They can wait for shipping a little bit and they're getting it. So I think Temu is affecting, the other kind of players, the retailers that are selling gadgets much more than it's actually affecting Amazon. I'm not saying it's not affecting Amazon. It is somehow, but not as much as the other players, especially the retailers. But in terms of Amazon, I'm not sure how this is going to work out, but they're going to offer a low price online store to compete with Temu. And it's going to be directly shipped from China. It's going to be interesting to see what really happens, but this is what they have in mind. They want to take over every single industry, even the telehealth industry. They announced recently a $49 telehealth service. I think they're trying to compete with Hims and Hers Health and many different players in telehealth stuff and mental health and therapy and BetterHelp, I think it's called. And many different kind of providers. And Amazon could, of course, be a huge player in the space. I mean, anything they could do amazingly well in it. But in terms of the valuation of Amazon, to me, this is how I look at it. I'm not trying to do a DCF. I don't like to keep things too complicated, and no one can really predict the future. But what I do in my videos, I try to bet on the most likely scenario. I don't try to bet on the unknown scenario. For example, I did talk about McDonald's. People told me it was trading at 10 times earnings 50 years ago. What is the likelihood McDonald's is going to go to 10 times earnings? It's very low. So this is how I think about that stuff, mainly common sense. Now, for the analyst, there's over 200 analysts putting numbers on Amazon. So far this year, 66%, and they've been beating it. So pretty amazing stuff. 25% for free cash flow growth. It's 26%. And 2026, it's around 33%. So I would say around 30%, free cash flow growth for Amazon. Now, 30% free cash flow growth for a company that's trading at 33 times free cash flow is not expensive at all. It's growing free cash flow 30%, and it is trading at 33% for an amazing company, massive company like Amazon, with plenty of international growth that's going to come, with plenty of different industries they can enter, amazing things that they can do, very good balance sheet also. They have pretty close to 85 billion in cash and cash equivalent marketable securities. Long-term debt is like 57 billion. So they have a positive net cash position. They could do amazing things. They haven't even started buying back in a major way. They haven't even started doing dividends at all, which they could do eventually in the future. And there are so many things they can do. But getting 30% free cash flow growth for 33 times earnings is not expensive at all. Now, the main argument I got is yes, that maybe they could potentially grow, around 30%. Maybe they could even exceed it. I know some people that invest in Amazon, that understand the company very well. They told me they could easily exceed 30%, even closer to 40%. And it's very, very possible because Amazon has been surprising a lot of people to the upside, and a lot of analysts too. So assuming they can get 33%, what can they really get after that? They cannot grow 33% forever. And I 100% agree. But if we look at the next 2 years, which are the most likely for us to be able to see them, to see with any kind of accuracy, they're expecting to get $103 billion in terms of free cash flow in 2 years, which is in 2026, if they do hit the 30%. Now, $103 billion, the current market cap is 1.9 trillion. This is like 19 times 2026 free cash flow. For Amazon, This is dirt cheap, dirt cheap. Even if after 2026 they only grow half of that, they don't even grow 30%. They grow something like 15% or 10%. I could still see 15, 16, 17% kind of annual returns for Amazon, even if they grow at 50% of the rate 2 years from now. And as a lot of the mature businesses mature within Amazon and they get more profitable within certain sectors and industries they're entering, free cash flow conversion could be much, much higher. So they could keep up the 30% for maybe 3 to 5 years. But even if they just keep it up for 2 years and they grow 15% instead of 30%, Amazon is a buy at this price. I think Amazon is not expensive at all. The only risk you could have is, insider selling. Jeff Bezos has been selling a lot of stock. He could be selling for many different reasons. He's been selling mainly around $200 per share, and now the stock is sitting at 183. But I mean, I think Jeff Bezos also sold before. You could see it here. He sold at 169. So imagine not buying at 169 because Jeff Bezos is selling. I mean, maybe he's selling for a different reason. And I doubt that this reason is going to affect Amazon over the next 5 years. So this is how I think about that stuff. And I never really sold a stock just because the insider is selling, because there's many different places or many different times where you could see a CEO selling, like with Walmart, and Walmart just keeps going up, and that's how it is. So for me, looking at Amazon, I think it's one of the best of the big seven. Amazon and Meta, I think they're the best valued stocks from the Magnificent Seven. I mean, I like them very, very much, especially Amazon. I think it's a buy and hold forever for most investors. For me, I focus more on small micro cap stocks. But looking at Amazon, I have to say I like it. I think it's fairly valued. It's not cheap, but it's not expensive either. And just because it went up, it doesn't mean that the stock is not a buy. I hope more and more people stop anchoring and they ignore the chart and focus on the value instead of the price. It's going to be very helpful and it's going to help you a lot. So I like Amazon. This is the first one. The second one is a stock called Visa. I'm going to keep it very short because I talked about it in another video. Visa is struggling to rally, but it's down 4% on the months in terms of Visa. And Visa is an amazing company. It doesn't need any introduction. But you're getting an amazing company with 56% net income margins, very high net income margin, 56%, very wide moat with, pretty good return on invested capital. And you're getting around 13, 14% earnings per share growth. And for a company that's trading at 25 times earnings, to me, 25 times earnings is not expensive at all for Visa. Over the last 5 years, it went as low as 22 times. Now it's sitting at 25 and a half, which I believe is not expensive at all for an amazing company, wide moat, amazing margins like Visa. 25 and a half times is not expensive. So I'm not seeing a multiple expansion, but I'm also not seeing a multiple contraction. If Visa does deliver 13% earnings per share, 12 to 13%, and they have like a 1% dividend, I could see 13, 14% annual return on Visa, which is like a double every 5 to 5.5 years. That's an amazing return on a mega cap stock like Visa. So I like Visa over here. I think it's fairly valued, maybe closer to undervalued. I like it very much. I also like Amazon for the very long term. I think it's a good buying opportunity here. It doesn't mean the stock can't go lower or Jeff Bezos can't sell more stock. But this is the best time to be buying them whenever stocks are going down and whenever you think a company is a good buying opportunity, which I believe it is. And this is just my opinion on Amazon and Visa. Just my opinion, not financial advice. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.